Welcome to Tech Money Madness, your daily U.S. stock market podcast, June 17th, 2026.
Glad to be here for this one because, wow, today is intense.
Oh, absolutely. Imagine generating $13 billion in top-line revenue in a single year, achieving over 250% growth, and somehow, still bleeding nearly $21 billion at the operating level.
Yeah, it's a lot to process.
Today's deep dive into the briefing notes reads a bit like financial science fiction. I mean, we are looking at a tape where capital is moving at a velocity that seemingly defies, traditional economic gravity.
Where the data you're looking at really paints a picture of a market forced to reckon with its own exuberance.
Okay, let's unpack this, because the overarching theme from your sources today centers on a single flashing red metric. The S&P 500's cyclically adjusted price-to-earnings ratio, or the KPE ratio, has just crossed 40.
And if we connect this to the bigger picture, the KPE ratio crossing 40 is, well, it's historically profound.
Yeah.
We're talking about a valuation metric created by Nobel laureate Robert Shiller.
Right.
And it smooths out 10 years of inflation-adjusted earnings.
Which is important because it removes all that short-term noise.
Exactly.
Yeah.
The goal of the KPE ratio is to remove the short-term noise of the business cycle and give us a true structural view of how expensive equities actually are.
Right. And prior to today, your sources note it had only breached that 40 threshold once in the last 150 years.
Yeah, just Russ.
During the absolute peak of the 1999 dot-com bubble. I mean, when the market prices equities at this multiple, it's essentially demanding years of flawless execution.
Uninterrupted compounding growth, yeah, just to justify the current premium.
It leaves absolutely zero margin for error.
None.
Which is why, in a market priced for absolute perfection, even standard upcoming earnings reports become these, high-wire acts.
Oh, for sure.
Take a look at your sources mentioning Podcaststone, trading under the NASDAQ ticker PODC. They're reporting their fiscal year 2026 results next week on June 24th.
Right, and normally, a media network's earnings are a fairly routine sector-specific event.
Yeah, usually you wouldn't blink twice.
But in a DP40 environment, ad revenue metrics and forward guidance from media companies, they're heavily scrutinized as leading macro indicators.
Because if advertising spend slows down there, it signals corporate belt tightening, right?
Exactly. And that could eventually crack the broader tech narrative. It is just a hypersensitive environment right now.
It really is. And that hypersensitivity is entirely dominated by massive capital reallocation.
Yeah, the market is aggressively pricing out potential macroeconomic headwinds because institutional capital is entirely focused on funding next-generation infrastructure.
Right. The euphoria surrounding these technological leaps is basically masking the underlying fragility of that 40 multiple.
Absolutely.
Which brings us directly to the actual market movers driving this tape. Because if you want to see what euphoria looks like in practice, today's top gainer and most active stock is SpaceX, ticker SPCX.
Which is just wild to see.
They just completed the largest initial public offering in market history. The scale of the capital raised in this public debut alone is staggering.
It's massive.
But here's where it gets really interesting. Immediately following this historic IPO, your notes indicate SpaceX turned around and deployed $60 billion into artificial intelligence technology that it couldn't build in-house.
Yeah, it is an incredible capital rotation.
Mm-hmm.
I mean, to understand why an aerospace manufacturer is deploying $60 billion into software, we have to look at the mechanics of modern orbital logistics.
Right. It's not just rocket fuel anymore.
Exactly. The integration of AI into computational fluid dynamics, autonomous telemetry, material science is no longer optional. It is the core driver of efficiency.
So they literally need this to operate at their current scale.
Yeah. SpaceX recognizing they need external specialized AI models to optimize their fuel loads and planetary navigation. It underscores a broader industrial reality.
Which is what exactly
companies are realizing that building proprietary foundation models from scratch is just economically unviable. Even for the best capitalized firms on Earth.
And the market is rewarding that realization instantly.
Well, yeah.
The briefing explicitly points out that the Procure Space ETF, ticker UFO, added SpaceX to its portfolio immediately. They're trying to capture this convergence of aerospace and AI.
Right.
The notes actually describe this capital injection as sending the, quote, space economy into warp speed.
Warp speed, yeah.
But let's follow that money. If aerospace companies are writing $60 billion checks for AI capabilities, we have to look at who is on the receiving end.
We do.
To understand the actual economics of the AI sector right now, we have to look at the leaked 2025 financials for OpenAI.
And the underlying numbers in this leak reveal the stark physical reality of the AI boom.
Yeah.
I mean, the top-line growth is phenomenal.
Yeah.
OpenAI's revenue grew an impressive 253%, reaching $13.07 billion in 2025. That is hypergrowth scaling that fully justifies those enterprise software multiples.
Right. However, their operating losses surged 138% to nearly $21 billion.
Yeah, it's a massive number.
We have to stop and really look at the mechanics of that loss. How does the undisputed software leader in the space generate $13 billion and still lose $21 billion?
That's a great question.
It's like building a massive rocket ship, but the faster you go, the faster your fuel tank leaks. Or, I don't know, it's like building a massive skyscraper, but the cost of the raw steel and the concrete doubles for every single floor you go up.
Right.
At a certain point, the rent you collect from the tenants doesn't even cover the interest on the crane. I have to push back on the sustainability of this model.
I get that.
I mean, aren't we just watching the .com bubble repeat itself with AI instead of pets.com? Are we just subsidizing compute costs to buy market share?
Well, it is largely an infrastructure and physics bottleneck.
Okay, explain that.
Training a multi-trillion parameter neural network is not just a software engineering problem. It is a heavy industrial process.
Right.
It requires tens of thousands of specialized GPUs running continuously for months. You're talking about immense power draw that fundamentally strains regional electrical grids.
Wow.
Yeah, requiring massive capital expenditures in specialized cooling infrastructure and, forward energy procurement.
So the revenue is scaling exponentially from API usage and enterprise subscriptions, but the marginal cost of compute to deliver those queries, the actual electricity, the facility cooling, the rapid hardware depreciation, it's currently outpacing the money coming in.
Exactly. The cost to maintain the intelligence is higher than the price they can currently charge for it.
That's wild.
Yet despite this $21 billion operating loss, the market is actively engineering new ways to lower the barrier to entry for capital to chase these exact assets.
Right, because everyone wants a piece of it.
Yeah. The briefing highlights ZoomX launching tokenized versions of major U.S. equities and ETFs, specifically targeting retail and institutional demand for AI and semiconductor stocks.
Let's break down the mechanics of tokenized equities, because this explains so much of the current market velocity.
It really does.
Tokenization essentially places a fractional representation of a traditional stock, like an AI or semiconductor equity, onto a blockchain.
Right.
By doing this, you fundamentally alter the liquidity dynamics. A retail investor globally doesn't have to wait for the New York Stock Exchange to open.
No, not at all.
And they don't have to buy a whole share. They can trade these fractional tokenized assets 24/7.
And by bypassing the traditional prime broker bottlenecks and settlement delays, you accelerate the velocity of capital.
Right, you just speed the whole thing up.
When you remove friction from the trading pipeline, capital flows much faster and much more aggressively into sectors with high momentum.
It acts as an accelerant.
Exactly. The tokenization of these assets is fueling the exact warp speed environment we are seeing, exacerbating the very valuations that pushed the TP ratio over 40 to begin with.
Right. If capital is flowing globally 24 hours a day through these frictionless tokenized pipelines into software companies that are burning billions on compute power, well, that money is inevitably landing on the balance sheets of the hardware providers.
Yep, someone's making that money.
The capital incinerated on the software side is booking as unprecedented margin expansion on the hardware side. Which brings us to NVIDIA, ticker NVDA.
Right.
Today's other top gainer and most active stock.
And NVIDIA's current architecture is the absolute benchmark for the brute force parallel processing required to train these massive foundation models.
They're selling the shovels in the gold rush.
Exactly. They are the primary beneficiary of the capital expenditure cycle we just discussed with OpenAI.
But NVIDIA's absolute dominance is creating a palpable desperation in the market, right? Leading to what might be the most aggressive thesis in your sources today.
Oh, the Trip Chowdhury note.
Yes. Wall Street analyst Trip Chowdhury is making a jaw-dropping prediction. He projects that Intel, a legacy fabrication company that has struggled for years, will reach a $5 trillion market cap.
In a massive call.
That implies an 848% upside from current levels.
Yeah.
His thesis centers on the industry structurally shifting from AI training to inference and applications. Now, we really need to challenge the magnitude of this.
Of course.
An 848% upside? Are we just blindly throwing darts at legacy tech companies hoping to find the next NVDA?
It feels like that sometimes, yeah.
Is the structural shift to inference really profound enough to justify pricing Intel at $5 trillion? Or is this just capital desperately hoping for a moonshot because of that TP ratio over 40?
Well, it is entirely rational to challenge an 848% price target on a company undergoing a highly complex foundry turnaround.
Right. Intel has a lot to prove.
But what's fascinating here is the architectural distinction Chowdhury is leveraging. We have to separate AI training from AI inference to evaluate the logic, regardless of whether you accept the $5 trillion valuation.
Okay, let's break that down.
NVIDIA established its moat in AI training, which is the incredibly resource-intensive phase of teaching a model by feeding it petabytes of data.
So if AI training is like building a massive, sprawling university and filling it with every book ever written, which requires thousands of construction workers and billions in capital inference, is the librarian who quickly fetches the exact book you need.
That's a great analogy.
You don't need a construction crew and heavy machinery just to fetch a book.
That is a highly accurate way to visualize the silicon requirements.
Yeah.
Inference, the phase where the deployed model actually answers queries, generates content, integrates into mobile devices or automotive systems. It requires low latency and power efficiency.
Right, it doesn't need all that heavy lifting.
Exactly. It does not require updating the weights of the entire neural network every time a user asks a question. As AI integrates into billions of edge devices, the total addressable market for power-efficient inference silicon is projected to absolutely dwarf the market for training hardware.
Okay, and Intel is aggressively attempting to pivot its entire foundry business and chip architecture to capture this specific low-power workload.
Yes, they are.
The desperation in the market is real because buyers desperately need a second supplier to break the current pricing monopoly on compute.
Definitely.
So Chowdhury is essentially applying a massive premium to Intel's potential to capture that inference volume. He's pricing the hope of competition as a certainty.
Precisely. It is a valuation based on a projected total addressable market rather than, current fundamental execution.
Right.
Which serves as a perfect contrast to the other side of the market ledger today.
Yeah, let's pivot there.
Because while speculative capital chases 800% returns in space logistics and inference architecture, the incumbent highly profitable tech giants are absorbing heavy losses.
Yeah, let's bring things back down to earth and look at today's top losers. On a day of massive upward market moves, Apple, Google, and Meta are uniformly bleeding.
They are.
Why are the absolute foundational giants of the last decade struggling to catch a bid in a euphoric market?
The sources attribute this directly to escalating regulatory friction. The era of unchecked global growth for incumbent tech giants is hitting a wall of governance.
What kind of governance?
Specifically, the briefing notes highlight that Apple, Google, and Meta are facing significant pressure regarding child safety and online platform responsibility, with Apple specifically pressured by the Kids Online Safety Act. Now, we are analyzing this strictly through the lens of market impact and operating margins, right? We're not taking any political stance on the legislation itself.
Of course. We're just looking at the market reaction.
But the reality for equity investors is that regulation introduces profound structural friction.
It fundamentally alters the capital efficiency of their business models.
Exactly.
I mean, if you are Meta or Google, your historical valuation premiums were built on frictionless network effects.
Right.
If legislation like the Kids Online Safety Act requires you to implement strict age gating or forces you to alter core algorithmic engagement models, your daily active user, your DAUs, could drop.
They absolutely could.
Furthermore, you have to build an entirely parallel compliance apparatus just to operate in your primary markets.
Exactly. Increased regulatory mandates require significant capital deployment into compliance infrastructure and content moderation,
Which costs money.
which means higher operating expenditures and potential fines. And that directly compresses their free cash flow margins.
Right.
In a market demanding perfection to justify a CAPE ratio of 40, any threat to the free cash flow of the mega-cap tech stocks triggers an immediate repricing.
So what does this all mean for portfolio construction? I mean, if you are the everyday investor navigating this data, you are staring at a Keat-E ratio of 40.
Yeah.
You see legacy tech giants facing margin compression from regulators and AI software leaders bleeding $21 billion a year.
That's a tricky spot.
How is institutional money positioning itself? It's like driving a car speeding at 100 miles per hour. At some point, you need to put on a seatbelt. Or, when market volatility is high and valuations are top-heavy, you need a ship's ballast. You need heavy, consistent cash flow at the bottom of the hull to keep the portfolio from capsizing when the speculative waves get rough.
The pivot toward quality factors and yield is a classic mitigation strategy in late-cycle elevated valuation environments.
Makes sense.
The briefing notes highlight a distinct rotation into dividend-paying tech companies. Interestingly, they point specifically to Microsoft and even Apple, despite its current regulatory headwinds as quality dividend payers.
Oh, that's interesting.
Because regardless of the compliance costs associated with new legislation, Apple still generates massive, reliable free cash flow globally.
But for investors looking for broader protection without single-stock regulatory risk, the sources highlight specific income-focused vehicles.
Right.
They identify massive inflows into dividend-focused ETFs, specifically naming the Fidelity High Dividend ETF, ticker FDVV, and the Vanguard Dividend Appreciation ETF, ticker VIG.
Two very popular funds right now.
For anyone allocating capital toward FDVV or VIG right now, the appeal isn't just the absolute dividend yield. It's the yield spread relative to the current risk-free rate, combined with a strict filter for balance sheet quality.
That is the critical distinction. These funds are heavily weighted toward companies with robust histories of not just paying dividends, but growing them.
Growing the dividend is key.
Exactly. That implies a level of operational maturity and pricing power that doesn't rely on zero interest rate environments or, constant equity dilution to survive. It is a rotation into mature cash flow.
But this raises an important question regarding capital allocation. Is shifting to income-focused ETFs actually a foolproof hedge against a historically terrifying CAPE ratio of 40?
This raises an important question indeed. While dividend aristocrats and income-focused ETFs offer downside mitigation through yield, they do not offer immunity from a broad market re-rating.
Right. If the market tanks, they still go down.
If the CPE ratio reverts to its historical mean, meaning if valuations contract across the board like they did following the dot-com peak, the principal value of the equities held within VIG or FDVV will still decline.
Right.
The strategic bet investors are making here is that the compounded yield will offset the capital depreciation far better than high beta growth stocks, especially if the AI capital expenditure cycle fails to materialize into proportionate enterprise revenue.
It's a strategy of mitigation, prioritizing companies that actually generate free cash flow today over those promising to figure it out a decade from now. Let's briefly recap the deeply bifurcated tape we've been navigating today. On one end of the spectrum, we see the absolute euphoric heights of capital deployment.
Yeah.
SpaceX pulling off the largest IPO in history and immediately dropping a $60 billion war chest into AI infrastructure. We see retail and institutional capital flooding frictionless, tokenized pipelines to chase momentum.
And we see analysts predicting a $5 trillion market cap for Intel.
Right, based purely on the hope that they can dominate the low-power AI inference market and break NVIDIA's monopoly.
But on the other end of the spectrum, the data forces a sobering reality check.
For sure.
OpenAI's $21 billion operating loss starkly highlights the physical and economic limitations of data center compute and energy infrastructure.
Yeah.
The broader market is carrying a CP ratio valuation that we haven't witnessed since the disastrous peak of 1999. And the reliable titans of the last decade, Meta, Google, and Apple, are increasingly tangled in a regulatory net that threatens to compress the very free cash flow margins that built their empires.
It is a market pricing in a utopian future for technological integration, while simultaneously scrambling for the safety of dividend yields to weather the structural costs of getting there.
Which leaves you with a critical dynamic to monitor and ponder as you review these briefing notes.
What's that?
The entire market's valuation is currently matching the 1999 dot-com peak, driven largely by the assumption that monumental AI infrastructure spending will seamlessly translate into global enterprise productivity.
Right.
But what happens if that productivity lags? When the math of a $21 billion operating loss finally catches up with reality, and the infrastructure build-out outpaces the inference demand. Will the ballast of dividend safety nets like FDVV and VIG be enough to stabilize portfolios?
That's a scary thought.
Or will this entire historic capital expenditure cycle require a painful market-wide reset to bring valuations back down to earth?
That is the multi-trillion-dollar question underlying all the data in today's notes. Key to challenging those extreme valuations, look closely at the underlying mechanics of these massive capital flows and continue stress testing your assumptions. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.